In this video, we're going to chat about the process of estimating the cash flows for projects. Now, this is a finance/accounting process. So, exactly where this happens in a particular corporation, is obviously is up to that corporation. But certainly, we need to know what inputs are necessary for this calculation so that we can determine values of projects. So here's the basic information we need. We need to know something about the cost of the assets, installation, shipping, etc. We need to know something about the life of the project. Although once we create this project, we may want to fine-tune this particular piece, as we've talked about in our previous videos. We need to estimate what the values of the assets will be at the end of the project's life, and what is the makers for the assets that we have in our project. This is for our depreciation, of course. We need to have an estimate of sales, the price, unit costs. What is our net working capital? How are we going to determine that? It could be just a very simple calculation of estimated sales, or a portion of estimated sales. We need to understand the tax rate. We need to understand or know what the weighted average cost of capital of the project is. And one of the things that makes this a lot more complicated is incorporating changes in cost. Primarily, let's think about inflation, right? How do we understand what prices will change and how they will change moving forward over this time frame? So we're going to estimate changes in prices. If we need to, we can break down the unit costs into the actual component costs. Obviously, this complicates the issue much more. So this is going to be more of a standard kind of a process. Essentially, what we want to create is something referred to as an incremental cash flow system. So this is going to be the cash flow that we predict if we do this project. We also want to predict cash flows if we do not do this project. So if this is a startup project, it's a brand new thing, we've never done it before, then these cash flows here without the project are zeros. Where this becomes important is when we're replacing projects or upgrading projects, because it is possible that we decide not to do it. So it could be complicated to the point where we need to have two full predictions of our assumptions under two different scenarios. So how do we deal with financing costs? So should we have interest expense or dividends in our cash flow prediction? And the answer here is no. The costs of financing are in the weighted average cost of capital. So we don't need to include it here, because then essentially we would be double counting it. So financing costs are not associated with the cash flows. They're associated with the weighted average cost of capital. What is a sunk cost? A sunk cost is something that you spend prior to even doing the project. We haven't even accepted the project yet. So this money is spent ahead of time. If we decide not to do the project, we've already spent the money. So should this cost be included in the analysis? Well, because it doesn't really matter what happens, we don't include it, right? Now, again, this is one of those things that's up to the companies. Some companies will include it, some companies will not. However, we have to keep in mind that if you include it in the process, in the analysis of whether the project is good or bad, right, in our cash flows here, then you are increasing the initial cost, which will decrease net present value by the amount of that sunk cost. We just have to understand the impact of what we're doing. We've already talked a little bit about incremental costs. So in this case, right, if the plant space we're using could be leased out for 25 grand a year, which should that affect our analysis? And of course, because it's an opportunity cost. So the after-tax opportunity cost of receiving this 25 grand, again, it's that amount times 1 minus the tax rate. In this case, it's an annual cost of $15,000. We have to incorporate this into our cash flows. Externalities happen frequently, especially when we talk about product lines, right? So if a new product line is going to decrease sales of the other products by 50 grand a year, should that affect our analysis? And of course, the answer is yes, because we're actually not going to receive that $50,000. So the net cash flow loss per year on other lines, again, would be a cost of this project. So externalities could actually even be positives, right? I mean, it could be positive project if it complements existing assets, and negative if they're substitutes to our current products. So let's start getting into some of our analysis, what we need to determine. So the first thing we need is to figure out for an asset is what is the asset's depreciable basis. So we need the cost of the assets, of course. We need to know what it's going to cost to ship the product. And then we need to know all of the costs associated with installation. Now, there's going to be a lot of things that might fit into this piece. We could have insurance. We could have tearing down a wall and rebuilding the wall to get the product. There are a whole lot of expenses that could be incorporated here. So that item it's going to take a little bit of work maybe to figure that all out. In this case, it's $240,000. In our worksheet that we're working with here, you need the initial cost of $240,000. Here's makers. That's the maker's life. What are the installation costs? Since I've included the installation costs up here, I don't need to include them down here. It kind of depends on how you get your data, right? So in this case, we want to know the depreciation, and here we have listed. It will calculate for us the asset for the depreciation for the next 4 years of this particular project. Another question that we need to be thinking about, should we include inflation when we're estimating our cash flows? Well, if the nominal required return is greater than the real required return, then that cost of capital includes premiums, right? If the nominal cash flows are greater than the real cash flows, again, this comes when the nominal cash flows incorporate inflation. So if we discount real cash flows with a nominal required return, net present value estimate's going to be too low. The nominal cash flows should be discounted with the nominal required return. If we calculated real cash flows, that should be discounted with real required returns. So it's more realistic to find nominal cash flows, and that is increase cash flow estimates with estimation. Do that within our estimation. Than it is to reduce the nominal cash flows to the real cash flows. So again, this just becomes a sticking point because at times certain companies may want us to adjust or show real cash flows rather than these cash flows that we include inflation in. So let's look at this particular project. What are our changes in cash revenues? So we have a calculation here of cash, that every year cash is going to increase by a certain amount. It looks like in the ballpark here about 3%. Then we're also going to change our cash expenses. What is that change going to be? We calculate here. So then this is ultimately going to be our change in earnings before depreciation and taxes. So this is essentially the first step in our income statement for this particular project. So now that we have, again, our changes in projects, here's our changes in EBDT. The next thing we need to do is to subtract out any change in depreciation. So this is the depreciation from our calculation in that previous slide. So now our change in earnings before depreciation and taxes, this now should be the change in taxes, that shouldn't be there. Subtract those out. So 100,000 minus 79 is 20. 100,000, 103 minus the 106. Now we have a negative change this year. That's okay. Then we have 70,000 and then 91,000. You calculate the taxes. Gives us our net income. Now we have our change in depreciation. We want to add depreciation back to our net income. That will then give us our change in cash flows after taxes. So again, here is our beginning part of the cash flows for this particular project. Now we have to consider something about our working capital. There's several ways we can estimate this. We can prepare an annual change in working capital statement, or we can prepare an initial investment and then a closing investment. So how do you want to do this? Well, it really kind of depends on the project. If working capital is going to be increased and decreased throughout the life of the project, you might want to make those adjustments. However, the simplest form is just to increase working capital at the beginning and then liquidate it at the end. So this is what this project does. It says, what is the actual new working capital investment? We're going to spend $24,000 in the beginning. Then over the next 3 years, we're going to reduce that even more. We're going to spend more money. So our working capital investment, again, our plant and equipment was at $240,000. And in the end, we spend all of this throughout the project. This number is the summation of this. So we're going to assume that when the project ends, all of the net working capital has been liquidated. So we have to show it leaving here. There's no tax on that because this is a part of using assets to create the project. So this is things like inventory, right? And how that may affect accounts payable, receivables, cash, etc. The next thing we have to consider then is the after-tax salvage cash flows. So there's, again, two ways we can do this. We need to determine the book value remaining at the end of the project. If the book value is greater than 0, then the salvage value minus that book value times 1 minus T. So in this case, again, this ending cash flow for this, we have to review those numbers and find out if the book value is greater. Now, at the end of the fourth year, we know that the book value is 0. So whatever our salvage value is, times 1 minus t, that will give us this final cash flows. So the final cash flows for our timeline, we're going to spend $264,000. Then we have a series of positive cash flows. The economic life of the project is done at the end of year 3. When we incorporate all of this into one slide and show how that all works together, we need to determine what is the discount rate, what is the reinvestment rate for our project, and then that will also then calculate for our project, we'll calculate our capital budgeting numbers to determine whether or not the project is viable or not viable. So I look forward to talking to you in the next video. Bye-bye.